Welcome to Hibiscus Petroleum's Financial Results Webcast. This webcast presents an overview of the results reported as part of our quarterly financial report for the 3-month period ended 30th September 2019 and released earlier today. This webcast has been prepared by Hibiscus Petroleum Berhad, or the company, solely for general information purposes only, and should at all times be heard and or viewed together with the full quarterly report for the same period that has been made available or published by the company on its website. This webcast may contain forward-looking statements which are based on current expectations, beliefs, and projections about future events or matters. By listening to and or viewing the webcast, you agree to the limitations and notifications set out in the disclaimer section of this webcast. Our presentation today is comprised of 6 components. In part 1, Uday Jayaram, our Vice President Corporate Development, will briefly introduce the company. In part 2, Deepak Thakur, our UK JV Asset Manager and Group Petroleum Economist, will provide an overview of and an update on developments at our UK producing asset, the Anasuria cluster. Mark Payton, our Group Chief Operating Officer, will then provide an overview of the Marigold and Sunflower discovered oil fields offshore in the UK continental shelf in part 3. In part 4, Dr. Pascal Hoss, the CEO of Sea Hibiscus Sdn Berhad, will provide an overview of our Not Sabah Malaysian producing asset. In part 5, Yip Chee Yong, or CY, our Chief Financial Officer, will present the highlights of the group's first financial quarter results for the financial year ending 30th June 2020. Kevin Robinson, our Special Projects Advisor, will then conclude our presentation with some of our key messages for this quarter in part 6. Should you have any queries, you may contact our Investor Relations team via the email address provided at the end of this presentation. I shall now hand over to Uday.
Hello, this is Uday Jayaram. I am Vice President Corporate Development at Hibiscus Petroleum Berhad. Let me commence this presentation by providing you with a brief introduction to our company. Hibiscus Petroleum was listed on the main market of Bursa Malaysia in July 2011, with a vision to be a respected and valuable pure-play independent oil and gas exploration and production company. Our 2021 mission is to secure 100 million barrels of net proven and probable or 2P oil reserves and or entitlement and achieve a net oil production of about 20,000 barrels of oil per day from currently held assets or potential new ventures located in areas of our geographic focus. We have approximately 1.6 billion shares in issue. These shares are held by more than 16,000 shareholders, with our core management team owning the largest single block of shares in the company with a 10.6% holding. Other corporate and institutional shareholders approximately hold a combined 56% interest in the company, while retail shareholders provide liquidity with circa 33% ownership. On the 7th of November 2019, our market capitalization stood at 1.5 billion ringgit. Hibiscus Petroleum is a component of the MSCI Global Small Cap Index, as well as the FTSE Bursa Malaysia Mid 70 Index. In addition, our listed securities are also Sharia compliant. Issued in March 2018 and set to expire in March 2021, we also have approximately 317 million warrants outstanding. The exercise price of these warrants is currently at 1 ringgit 6 sen. The exercise price will step up by 6 sen to 1 ringgit and 12 sen on the 20th of March 2020. Today, our key activities are focused on efficiently monetizing our producing oil fields and growing our portfolio of development and production assets in areas of our geographical focus. These areas are in the United Kingdom, Malaysia, and Australia. The company currently has 2 producing assets. The first being the Anasuria cluster of oil and gas fields located in the UK North Sea, which we acquired about 3 years ago. Since our acquisition of this asset, the Anasuria cluster has contributed significant positive cash flow and profits to our company. Over the first quarter of financial year 2020, the Anasuria cluster delivered an average of approximately 2,600 barrels of oil equivalent per day, net to our company. In addition to the Anasuria cluster, we became the operator of the 2011 Not Sabah Enhanced Oil Recovery Production Sharing Contract, or PSC, on 31st March 2018. We have a 50% participating interest in this PSC, with the remaining 50% non-operated participating interest being held by Petronas Carigali, a wholly owned subsidiary of Petroleum Nasional Berhad, or Petronas, the national oil company of Malaysia. For our 50% participating interest in the North Sabah PSC, our estimated entitlement of daily oil production over the first financial quarter was approximately 5,100 barrels of oil per day. In summary, the total oil and gas production rate across both our assets averaged approximately 7,700 barrels of oil equivalent per day over the first financial quarter, of which oil production contributed 7,500 barrels per day. Within our current portfolio of assets, our total net proven and probable reserves as of 1st January 2019 stood at 50.7 million barrels of oil, while net contingent oil resources stood at 71 million barrels. Financially, our balance sheet is continuing to strengthen. As of 30th September 2019, our net assets stood at 1.3 billion ringgit, and our unrestricted cash balance stood at 179 million ringgit. We also continue to operate without debt. Our current portfolio, consisting of 1 exploration, 2 development, and 2 producing assets, is spread across 3 continents. In Asia, we operate a production sharing contract in Malaysia, while in Oceania, we operate in Australia. In Europe, we are present in the United Kingdom and have interests in several fields under concession agreement type arrangements. Firstly, we jointly operate several producing fields in the Anasuria cluster. Based on an independent assessment, the total net 2P oil reserves in the Anasuria cluster are 23.7 million barrels of oil as of 1st January 2019. Secondly, we're also the operator of Blocks 15/13A and 15/13B, a development asset. These blocks include the Marigold and Sunflower discovered oil fields. We are also in the process of completing the acquisition of Blocks 15/18D and 15/19B, which include the Crown discovered oil field. In Malaysia, we operate 4 producing fields under the North Sabah PSC, which together contain net 2P oil reserves of 20.5 million barrels of oil. In Australia, under a concession type agreement, we have approximately 6.5 million barrels of 2P oil reserves located in the Vic L31 West Seahorse development asset, which we operate. The future potential of each of our assets is further underpinned by volumes of oil which have been classified as contingent resources. In the United Kingdom, material contingent resources are located in the Marigold and Sunflower oil fields, in which we have a 50% interest. These 2 discovered oil fields contain approximately 30 million barrels of 2C oil resources net to the company. Another 7.8 million barrels of 2C oil resources net to the company are located within the fields of the Anasuria cluster. Between 4 and 8 million barrels of 2C oil resources are contained within the Crown discovered oil field, subject to independent third-party expert assessment. In Malaysia, our net 2C oil resources in the North Sabah fields amount to circa 31.7 million barrels of oil. In the months and years going forward, we intend to gradually convert these contingent resources into proved and probable reserves or entitlement barrels, thereby further enhancing the value of our asset base. Finally, in terms of exploration assets, we also operate the Vic P57 license, which we believe contains exciting opportunities. We also recently exercised an option to acquire a non-operated 50% interest in the Vic P74 exploration license, located in the same area as Vic P57. These assets hold significant potential for our future development plans. In the Vic P57 license, 2 key prospects have been identified. The first is Felix, with best estimate prospective resources of net 23 million barrels of oil, and the second being Pointer, with best estimate prospective resources of net 128 billion cubic feet of gas. We currently have a 75.1% direct interest in Vic P57 and are now in the process of farming out the license for a carry-on 1 well to be drilled in 2021 or 2022. A data room is in place with several companies currently assessing the opportunities that we have identified. The chart on your screen depicts the group's average daily oil production target by 2021. Our target for the 2020 financial year is to deliver between 3.3 and 3.5 million barrels of oil across both the Anasuria and North Sabah assets. In order to achieve our 2021 mission of producing 20,000 barrels of oil per day, our main focus will entail enhancing production at Anasuria and the North Sabah fields, and positioning for further acquisitions of producing assets with a focus on adding to our existing portfolio in Southeast Asia. Deepak will now take you through the details of the Anasuria cluster, which is located offshore in the United Kingdom in part 2 of this webcast.
Hello, I am Deepak Thakur. At Hibiscus Petroleum Berhad, I have two roles. I am the JV Asset Manager for the Anasuria cluster. In addition, I am also the Group Petroleum Economist. I will now take you through some information on our first producing asset, the Anasuria cluster. Our indirect wholly owned subsidiary, Anasuria Hibiscus UK Limited or AHUK, has been involved in the joint operations of the Anasuria asset for over 3 years. This asset is located about 175 kilometers east of Aberdeen in 94 meters of water and has been producing since 1996. Based on an independent reserves assessment and the assumptions contained therein, effective 1st January 2019, the estimated remaining economic life of the asset is up to 2038. Our interest in the Anasuria cluster comprises a 50% direct interest in the Teal, Teal South, Gilmore A and Kite fields. We jointly operate these fields together with our partner Pink Petroleum through a jointly owned legal entity incorporated in the United Kingdom called the Anasuria Operating Company Limited. We generally refer to the Anasuria Operating Company Limited as AOC. The cluster also includes the Cook field, and in this field, we have a non-operated 19.3% interest. We also own a 50% direct interest in the Anasuria FPSO. Included as part of the Anasuria cluster are all components of the installed subsea production infrastructure and the Anasuria FPSO. Taking a closer look at the field layout, the subsea infrastructure underpinning the production of hydrocarbons is quite extensive and spans 25 kilometers from north to south. We utilize the services of Petrofac, a reputable international oil field service provider, in the role of a duty holder for the offshore facilities, pipelines, and wells. Our joint ownership of the Anasuria FPSO and management of operating costs through a risk-reward type arrangement with Petrofac are key drivers in keeping our unit production cost at competitive levels for this type of facility. In Anasuria, the average uptime achieved for the current quarter was 77%, while the average daily oil equivalent production rate was 2,589 barrels of oil equivalent per day. One crude oil offtake was conducted at Anasuria in August 2019, in which approximately 272,000 barrels of oil net to AHUK was sold at an average realized oil price of $58.41 per barrel. The average OPEX per barrel of oil equivalent in Anasuria for the current quarter was $26.04 per barrel of oil equivalent. Operational performance in the current quarter was affected by the planned 2019 offshore turnaround, which commenced at the end of June 2019 and subsequently completed in July 2019, as well as other planned maintenance activities. To recap, an offshore turnaround in Anasuria is a periodic, planned activity when the Anasuria FPSO is completely shut down so that the maintenance activities can be carried out to improve the overall performance of the production facilities. Offshore turnaround activities are also key to ensure that we continue to provide a safe workplace environment for our offshore personnel. The last offshore turnaround was conducted in 2017 for a period of 1 month. Post the 2017 offshore turnaround, average uptime improved to levels between 82 to 94%. It is hoped that subsequent to the conduct of 2019 offshore turnaround, average uptime levels will be maintained or further improved for the financial year ending 30th of June 2020. In summary, whilst planned maintenance activities affect operational performance, these are critical enablers of a safe working environment and overall can lead to an improved performance of the offshore facilities. Barring unforeseen circumstances, these measures, together with the production enhancement projects that are being executed this year, are expected to improve the operational performance of the Anasuria asset in the 2020 financial year. The projects identified on this slide have the common objective of taking us towards the target of delivering up to 5,000 barrels per day net to Hibiscus Petroleum by 2021. Referring to the projects itemized in the table on this slide, the Gilmore P2 sidetrack well, which was executed last year, has been contributing positively to the company since it commenced production in September 2018. The Cook Water Injector project, which was sanctioned in May 2018, consists of two phases. The first phase entails the drilling of a well through which water would be injected to repressurize the Cook field. The second phase is to install a pipeline connecting the new well to the water injection pumps located on the Anasuria FPSO. We expect the secondary recovery activity to arrest the natural decline of the production from the Cook well with the added benefit of delivering an improved recovery factor from the field. To recap, the Cook field is operated by Ithaca Energy, and this project was sanctioned by the joint venture partners in May 2018. Drilling operations on the water injection well commenced on 25th of March 2019, and on 2nd of May 2019, the well was drilled to a total measured depth of 13,045 feet, or at a true vertical depth subsea of minus 12,248 feet. Activities to drill and complete the water injection well were completed on 25th of May 2019, ahead of our base case plan. In drilling the water injection well, reservoir pressure at the injection well location was found to be as predicted. Additionally, the oil-water contact is deeper than originally anticipated. The implication of a deeper oil-water contact is positive and is anticipated to increase our net 2P reserves in the Cook field. We will make a further disclosure when the detailed work to establish the latest reserves estimate has been completed. The installation of the subsea pipeline to link the water injection well to the Anasuria FPSO was carried out in the current quarter, and the injection of water into the Cook field reservoir commenced on 4th of October 2019. Our total net capital expenditure for this project is estimated at 61 million ringgit. Of this amount, 49.6 million ringgit has been incurred in the period since the project was sanctioned and up to the end of current quarter. The remaining 11.4 million ringgit will be incurred over the remaining months of the 2019 calendar year. Similar to the Gilmore P2 sidetrack conducted last year, the Gilmore P1 sidetrack project is an opportunity to drain additional volumes of oil by drilling a sidetrack well from the existing Gilmore P1 oil-producing well. Drilling operations commenced with the Stena Spey drilling rig mobilized to location and deployed anchors on 17th of May 2019. On 28th of July 2019, the well reached a total depth of 11,615 feet measured depth and encountered approximately 445 feet true vertical depth subsea of oil-bearing sands, with a net pay of 190 feet true vertical depth subsea in the targeted reservoirs of the Gilmore A fields. The relevant hydrocarbon-bearing zones were perforated on 16th of August. The well was then cleaned up and hydrocarbons were flowed to the surface at the end of the August. Subsequently, the well was hooked up to the Anasuria FPSO and achieved a stabilized net production flow rate of approximately 900 barrels per day. Whilst the well has commenced production, the final scope of this project to install a gas lift jumper to enhance production was conducted as part of a diving campaign executed in October 2019. We expect that net capital expenditure for this project to be approximately 98 million ringgit, with an objective to unlock approximately 1.7 million barrels of oil from our current net 2P reserves. 93.3 million ringgit has been incurred up to the end of current quarter, with the remaining amount to be incurred in the rest of calendar year 2019. I will now hand over to Mark, who will give you an overview of the Marigold and Sunflower assets.
Hello, I'm Mark Payton. I'm the Group Chief Operating Officer. I will now briefly take you through the key points of our interests in Blocks 1513A and 1513B. These are development assets and also located in the United Kingdom. On 17th of October 2018, we announced that our indirect, wholly owned subsidiary, Anasuria Hibiscus UK, had completed the transaction to acquire a 50% interest in Blocks 1513A and 1513B for a total purchase consideration of $37.5 million. The The blocks are located offshore in the UK sector of the North Sea, approximately 250 kilometres northeast of Aberdeen, in water depth of 140 metres. Block 1513A consists of a significant oil-bearing discovered field called Marigold, whilst Block 1513B, which lies northeast of the Block 1513A, consists of a smaller discovered field called Sunflower. Based on an independent report by AGR Tracks International Limited, the gross 2C contingent oil resources in the blocks are estimated to be 60 million barrels of oil. As we have 50% interest in the blocks, this translates to 30 million barrels of 2C contingent oil resources net to Hibiscus Petroleum. This acquisition presented an opportunity for us to expand our footprint in an area of our geographic interest and is consistent with our 2021 mission. In addition, given that production from the Anasuria cluster generates taxable profits, we believe that the development of these newly acquired fields may provide us with an opportunity to optimise our near-term tax position whilst accreting value to all stakeholders through the addition of production. As the operator of these blocks, we have established a dedicated project team in Kuala Lumpur, coupled with a modest presence in Aberdeen, Scotland. The project team has been tasked with conducting the subsurface field development and engineering studies, and with the support of third-party contractors, execute the concept select phase as part of the effort to establish a field development plan for Marigold and Sunflower by the end of calendar year 2020. The development options that were considered included the use of a fixed platform, floating solutions, as well as a tieback to nearby existing infrastructure. A subsea tieback of an FPSO has been determined as the preferred concept, and the final concept select report was submitted to the OGA for their review and consent in the current quarter. We subsequently received a letter from the OGA in October 2019 stating that they have no objections with our preferred concept. We have now commenced with the front-end engineering and design phase to continue the progress towards a field development plan. In terms of capital expenditure, approximately 2.4 million ringgit has been incurred in the current quarter. We have also identified several stranded discoveries around Marigold and Sunflower fields. We believe that potential collaboration with concession owners of some of these stranded discoveries located around our blocks is feasible and will allow reduction in the overall unit development and production costs for all parties. This slide represents the potential value accretion of the Marigold and Sunflower fields as we achieve key milestones towards our first oil objective from these assets. We purchased interests in the blocks in which these fields are located, and based on reports from third-party competent experts, they contain approximately 30 million barrels of 2C contingent resources net to the group. We paid $37.5 million for these interests. This results in an acquisition cost of $1.25 per barrel. We are currently working on activities which will enable the selection of the appropriate development concept. Once the development concept has been finalised, our first key milestone will be the achievement of the final investment decision for this project to develop these fields. This will be followed by securing the approval of the Oil and Gas Authority for the Field Development Plan, or FDP. We target to achieve this milestone by the end of 2020 calendar year. Once the final investment decision has been made to develop these fields, we anticipate that we will farm out some of our interest in Marigold and Sunflower assets. Our objective of reducing our interests is to ensure that we're able to fund the development of these assets without overextending ourselves from a gearing perspective. The next key milestone will be to achieve first oil by the end of calendar year 2022. In summary, we are excited by the potential value to be derived from the Marigold and Sunflower fields. We see this asset as a game changer for the group, boosting our net oil production rate and establishing the group as a mid-size E&P player. On the 7th of October 2019, we announced that Anasuria Hibiscus UK had signed a conditional SPA to acquire 100% interest in licence P2366 from United Oil and Gas plc and Swift Exploration Limited. The total cash consideration of up to $5 million is to be paid based on a series of milestones and an overriding royalty scheme. Licence P2366 containing blocks 1518D and 1519B is located offshore in the UK sector of the North Sea, approximately 250 kilometres northeast of Aberdeen and 12 kilometres southeast of the Marigold field. It includes the Crown Discovered field, which consists of 2C resources of between 4 and 8 million barrels of oil, subject to an independent third-party expert's assessment. This transaction is an opportunity for us to aggregate 2C resources from the Crown Discovery at a competitive unit cost per barrel and integrate these contingent resources as part of the Marigold area-wide development with the objective of reducing the overall unit development and production costs. This proposed acquisition is subject to receipt of regulatory approvals for the assignment of the licence to AHUK and the appointment of AHUK as operator. I'll now hand you over to Pascal to provide a business overview of our Malaysian North Sabah operations.
Hello, I am Pascal Hos. I'm the CEO of Sea Hibiscus Sendirian Berhad. Sea Hibiscus is the holder of a 50% participating interest in the 2011 North Sabah Enhanced Oil Recovery Production Sharing Contract, or PSC. We are also operator of this PSC. The remaining 50% participating interest is held by Petronas Carigali Sendirian Berhad. This is our first PSC in Malaysia, and our participating interest was acquired through a transaction with the Shell Group that was successfully completed on the 31st of March 2018. The North Sabah PSC has delivered production since 1979, and our production rights under the PSC continue until 2040. Through the PSC and the joint operating agreement signed with our partner Petronas Carigali, we have a 50% participating interest and operatorship of 4 producing oil fields offshore Sabah, namely St. Joseph, South Furious, SF30, and Barton. We also have the operatorship of the Labuan Crude Oil Terminal and all other equipment and assets related to the PSC. As reported by our independent technical valuer, Risk Advisory, and based on our participating interest, the net 2P oil reserves of the fields under this PSC are 20.5 million barrels as of 1st January 2019 through to the end of the PSC life in 2040. Risk Advisory had also estimated that the 2C contingent oil resources in the fields covered by this PSC, based on our net entitlement, are 31.7 million barrels. Thus, we believe this asset holds a great deal of future potential. Subject to oil price and regulatory approvals, we hope to be able to allocate capital and our technical capabilities towards unlocking the available 2C contingent resources. The table on this slide shows the operational performance of the North Sabah asset over the past 4 quarters. That is from the 1st of October 2018 until the 30th of September 2019. During the current quarter, North Sabah production facilities recorded an average uptime of 85%, lower than the previous quarter due to plant shutdowns for maintenance and infill drilling activities. Consequently, average gross oil production decreased by approximately 4% during the current quarter. However, some of the production losses were offset by new crude oil production from the completion of the St. Joseph infill drilling project and continuing production enhancement activities. Average OPEX per barrel for North Sabah for the current quarter increased to $16.72 per barrel due to lower production and higher production OPEX from plant maintenance activities during the current quarter. During the current quarter, we conducted 1 crude oil offtake. A total of approximately 335,000 barrels of oil were sold at an average realized price of $63.63 per barrel. Overall, we are pleased with our operating performance for this quarter. In April 2019, we were recognized by Petronas at the Reservoir Management and Surveillance Summit with the Production Delivery Award for our calendar year 2018 operations. Additionally, we received the Focus Recognition Award from Petronas in September 2019 for demonstrating prudent deferment management of the North Sabah PSC, which ensured the highest standards of asset integrity. We continue to work towards aggressive production targets and pursue cost reduction opportunities without compromising the high health and safety standards that are expected in our industry. Referring to the projects shown on this slide. In August 2018, Petronas approved the St. Joseph infill drilling project through the Milestone Review 4 project maturation process. As part of the same process, Petronas subsequently approved the field development plan in December 2018. This project entailed the drilling of 3 infill producer wells utilizing a triple splitter wellhead from the St. Joseph Jacket A platform. There was also a requirement for minimal topside facilities modification. Drilling operations commenced when the rig mobilized to location on 22nd May 2019, and the project completed in August 2019. The 3 infill wells reported a combined stabilized flow rate of over 3,200 barrels per day gross, exceeding our pre-drill expectations of 2,600 barrels per day. In addition, this project will add 2.77 million stock tank barrels of gross 2P reserves to the asset. The total gross capital committed to this project is approximately 143 million ringgit. This is being shared equally with our joint venture partner, Petronas Carigali. Like the St. Joseph infill drilling project, the SF30 infill drilling project entails the drilling of 3 infill producer wells at the South Furious Jacket C through the last remaining conductor slot and will require minimal topside facilities modifications. We obtained Petronas approval in July 2019 for the SF30 infill drilling project development plan, which is intended to increase production and reserves of the South Furious 30 field. The total estimated capex is approximately 127 million ringgit, which will also be shared equally with Petronas Carigali. Drilling commenced in August 2019, and we have successfully completed and brought online 2 out of the 3 planned infill wells. The first well, SF32, was brought online and produced its first oil on 8 October 2019. The well has been tested at approximately 1,100 barrels per day, with the production choke at 3864 setting and no indications of water or sand production at surface. The SF32 well is being closely monitored, and the production choke will continue to be gradually increased to maximize production potential. The second well brought online, SF34, produced its first oil on 26 October 2019. This well will be monitored closely for sand and water production prior to increasing the production choke to maximum production capacity. Drilling and completion of the third well is currently in progress. The SF30 Waterflood Phase 1 project development plan was approved by Petronas in October 2019 and is ongoing, with water injection expected to commence in January 2020. This project entails the drilling and completion of 1 infill water injection well through a new conductor, with the goal of scoping out the effectiveness of water injection as a means of repressurizing and providing long-term reservoir pressure support for the SF30 field. Phase 1 of this project is intended to assess the viability for a full field water injection project. Total capital expenditure of approximately 51 million ringgit will be shared equally with our joint venture partner. This 7-well drilling campaign is consistent with our objective to enhance production from the North Sabah asset and demonstrates that Malaysia is an integral part of our long-term business strategy. I will now pass you on to CY, who will take you through the financials of the group for the current quarter.
Hi, I'm CY, the group's Chief Financial Officer. I'll take you through the financial highlights for the current quarter. The current quarter represents the 6th quarter that actual North Sabah business performance data under the operatorship of Sea Hibiscus is being reported for detailed analysis. Earnings before interest, taxes, depreciation and amortization, or EBITDA, for the North Sabah asset is reported at approximately 47 million ringgit for the current quarter from the sale of 334,000 barrels of crude oil in one offtake. Average realized oil price achieved in the current quarter was $63.63 per barrel, while $72.59 per barrel was achieved in the previous quarter. The EBITDA margin for the current quarter remained at 52% compared to the previous quarter, despite the lower average realized oil price achieved in the current quarter. Additionally, average uptime in North Sabah in the current quarter of 85% was lower compared to 94% in the previous quarter, while average gross oil production declined by approximately 4% compared to the preceding quarter. These factors and higher costs incurred on the planned maintenance activities had resulted in average OPEX per barrel to increase from $13.60 in the previous quarter to $16.72 in the current quarter. The tax regime under which Malaysian oil and gas activities are governed, and is thus applicable to C. Hibiscus, is the Petroleum Income Tax Act 1967 or PITA. The provisions of PITA are applied to net taxable petroleum income at a rate of 38%. Net tax charge for the North Sabah segment in the current quarter amounted to approximately 18 million ringgit, resulting in a profit after tax of 8.3 million ringgit. It was mainly caused by taxes levied on profits generated from operations, partly offset by reversal of deferred tax liabilities. In addition, there was recognition of tax liabilities to adjust certain tax-related estimates originally advised by the previous operator of the North Sabah asset upon completion of the acquisition of the asset on 31st March 2018. Adjustments to such estimates were confirmed by the sellers to C. Hibiscus during the current quarter, upon them finalizing their annual statutory tax submissions. Turning to the Anasuria Hibiscus segment in the United Kingdom, EBITDA achieved for the current quarter was approximately 35 million ringgit. The EBITDA margin was 51% compared to 65% in the previous quarter. Revenue recorded in the current quarter amounted to 69.3 million ringgit compared to the previous quarter's revenue of 87.9 million ringgit. The decrease was due to both lower number of barrels sold and lower average oil price realized. Anasuria Hibiscus sold 272,000 barrels of crude oil at an average oil price of $58.41 per barrel in the current quarter. In the previous quarter, 202,000 barrels of crude oil were sold at an average realized price of $66.84 per barrel. In addition, average uptime and average OPEX per barrel of oil equivalent in the current quarter of 77% and $26.4 respectively respectively less favorably when compared to the previous quarter, where the respective metrics attained were 87% and $20.93 respectively. For the current quarter, profit after tax delivered by the Anasuria Hibiscus segment amounted to approximately 13 million ringgit. In the United Kingdom, the total tax rate for Anasuria Hibiscus is 40%, which consists of a ring-fence corporation tax and a supplementary charge at 30% and 10% respectively. 4.5 million ringgit net tax expense were recognized in the current quarter, a decrease of 34.5 million ringgit as compared to a net tax expense of 39 million ringgit in the previous quarter. Income tax expenses in the current quarter amounted to approximately 3 million ringgit, compared to approximately 26 million ringgit in the previous quarter. Total income tax expenses accrued in the previous quarter was higher due to the recognition of higher income tax liabilities subsequent to a reassessment of year-to-date income tax obligations in that quarter. It was also impacted by higher revenue achieved in the previous quarter. In addition, net deferred tax liabilities recognized in the previous quarter were higher by 11.1 million ringgit. Whilst profits are extremely important, management's focus remains on delivering strong and sustainable EBITDA levels as long-term business continuity is of the highest priority. Our business performance is underpinned by several factors, predominantly the price of the Brent crude oil benchmark at approximately the time of a scheduled offtake from our crude oil storage facilities. Given that oil price is affected by global macroeconomic factors which are not within the control of the company, focus is placed on the operational performance of the assets, such as production rates and facilities availability, as well as the management of operational expenses. A key metric that we utilize to track our operational performance is average unit production cost. The average unit production cost for both the Anasuria cluster and the North Sabah PSC are well below the average realized oil price achieved in the respective quarters. As shown in slide 23, we have seen oil prices much lower and higher than the current crude price levels, and we have managed on all occasions to remain profitable. The careful management of costs to maintain low operational expenditure and the delivery of production enhancement projects are key towards obtaining a low unit production cost structure. This is a significant contributor towards our profitability. We wish to reiterate that management's focus remains on delivering strong and sustainable EBITDA levels, as long-term business continuity is of the highest priority. Over the past few quarters, our balance sheet has been gradually strengthening, more so with the introduction of the North Sabah asset as part of the group's overall business portfolio since 31st March 2018. We have built our total assets to approximately 2.6 billion ringgit, and shareholders' funds stand at about 1.3 billion ringgit. Year on year, total assets have increased by 15%, while shareholders' funds have risen by 13%. Net assets per share currently stands at 79 cents. In addition, as at 30th September 2019, the group's unrestricted cash balance stood at a healthy 179 million ringgit. The restricted cash recorded in our results relates to a security for our portion of the estimated cost of decommissioning the facilities of the Anasuria cluster. In this regard, we are required to periodically place monies into a trust, and this commenced 18 months after the completion date of the Anasuria cluster acquisition. This activity will continue until such time that the security has been fully provided. As of 30th September 2019, a sum equivalent to 73.6 million ringgit has been deposited with a UK trustee to support our ongoing obligations in this area. To note, the group remains debt-free, as all our activities and acquisitions to date have been funded with equity and internally generated funds. Over the course of the next 6 months, we anticipate that we shall undertake certain capital raising initiatives to ensure that the projects and opportunities we have in hand, which are expected to enhance production and create value, are executed smoothly. We are evaluating our options bearing in mind factors such as long-term capital requirements, the overall weighted average cost of capital, as well as preference for the group to maintain a certain level of agility and financial flexibility, amongst others. As our plans mature, we shall make the relevant disclosures. Before we wrap up, I would like to hand over to Kevin to highlight a few takeaway points.
Hello, I'm Kevin Robinson, Special Projects Advisor. I would like to close this presentation with some key messages. Hibiscus Petroleum is positioning for further acquisitions of producing assets with a focus on adding to our existing portfolio in Southeast Asia. Our financial year 2020 target is to deliver between 3.3 and 3.5 million barrels of oil safely and efficiently. We are maintaining our 2021 target of 20,000 barrels of oil per day, comprising of 7,000 barrels per day from the North Sabah asset, 5,000 barrels per day from the Anasuria cluster, and a minimum of 8,000 barrels per day from new producing assets. Our target is for the final field development plan for the Marigold development to be secured by the end of 2020. We continue to build our technical capability and track record as a capable operator, having recently received awards and recognitions for operational, safety, and business performances in Malaysia and the United Kingdom. Furthermore, we aim to deliver consistent and strong EBITDA margins through the management of our unit production costs. We wish to highlight that the group currently has no debt and is in a position to gear up to a conservative level as a need arises. We are excited by the activities and opportunities that lie ahead for Hibiscus Petroleum and hope that upcoming developments will act as a positive value-enhancing triggers for our shareholders.
And that's all we have for this quarterly earnings webcast. Thank you for tuning in.